All right, how about that for an intro, huh?
I'm liking those beautiful colors.
Psychedelic. Hello, everyone, and hello, Ashley. Welcome back to our every other Tuesday first time home buyer seminar. If it's your first time here, we're excited to have you. And this is where we are going to be answering all of your questions about how to go about buying your first home, from talking to the lender, getting pre-approved, to getting with your realtor and narrowing down your choices, looking in your neighborhoods you want to be looking in, what type of home you want, what type of loan you want, how much can you afford, all of those great things and more right here. And let me welcome Ashley. Here's Ashley, everybody. This is Ashley Westbrook. Say hi.
Hi,
There
how's
she
it
is.
going? Thanks so much for taking time to visit with us today. We want to make sure that we're keeping this short and sweet. We get you're busy. Thanks so much for popping by. And if you have to pop on here any minute, I think that you'll definitely be able to take something valuable away from this call. So thanks for showing up tonight.
Thank you, Ashley. Appreciate it. So, again, this is recorded. We will show it's live now, but it will be recorded. So, if you happen to tune in on one of our social media platforms, you'll be able to pause it, rewind, and take notes. Listen to it, watch it at your own leisure. Go back to it when you want. But if there's no questions right now, let's go ahead and get started. We're going to try to run through this in about 30 minutes or less. And then if we have questions, we'll take those questions at the end. So if you want to take some notes, jot down some questions, we will be more than happy to answer those as we move along. All right, so let's talk about here's our goals for this course. We're going to learn the advantages of owning a home. We're going to talk about the different loan programs that are available to you. We're going to discuss the cost of home ownership, and we'll understand how credit scores affect your options when you're trying to buy. And we'll show you how to complete the pre approval process and how you get that pre approval letter so you can start shopping for a home. And then we'll answer any questions that you may have. So, why buy instead of rent? So, if you're here, you've probably been renting for a long time. You're renting now, and you're starting to realize rent is going up, getting higher and higher, and all you're doing is just throwing that money away, right? You're making your landlord wealthy, and you're not investing in yourself. So let's talk about that. Owning a home is actually it can be a wise investment, depending on where you are in your life. If you invest now, you're going to find that in a few couple of years even you'll have some money available to you and you'll be in a better position to go and buy your next home. So if you buy a starter home, it's just going to, like it says there, number two, the homes are going to tend to increase in value, right? So if you get it now, in a few years you'll have some equity there. You can take that equity and go buy your next home. That's what number three is talking about. And then a fourth advantage is the interest you pay over time. Every year you're paying interest on that home. You talk to your CPA about that. That's tax deductible, so you get to write that off. Now, you can also personalize your home. Now, you can personalize an apartment, but a lot of times, if you're in a townhome and certain apartments, they've got a lot of restrictions. You personalize your home, you make it the home you want. If your family's growing, maybe you're planning to have children soon, you need more room, and you know how much it's going to cost if you move up to that 2 or 3 bedroom apartment, right? So that's why it's a wise investment to start looking at home ownership. And the starter home, look, when you're driving through, I know for myself, and I used to think this years ago, I'm driving through neighborhoods, I'm seeing these big, beautiful homes. I'm thinking, my goodness, what in the world do these people do to be able to afford these homes, right? Well, listen, a lot of those people, they didn't just go buy that house. They were in an apartment and a townhome, and then maybe they bought a condo, then they bought a starter home, and then 2 or 3, 4, 5 years later, they went and bought their next home. So that home you see them in now, they may, it might have taken them 15, 20 years to get into that big, massive home, but they did it gradually, time after time, by making that first investment, moving to from your starter home to the next home and on down the line. So that is another great way to look at this and how you're investing in yourself rather than your landlord. So, how do you begin? Well, it's really a lot easier than you might think. It seems like a big, challenging, scary thing to do, but it's really not. If you basically, we'll show you, we're going to walk you through it, but you want to, like it says here, find your home team of experts. So that's what Ashley and I do. She is an expert in real estate. She is going to know the market, know the type of home she can get you into. She's going to know if you're talking about what style of home, areas of town you want to be in. You want to be near schools, you want to be near a lake, you want a home with a pool, whatever. She will know that. She's got access to all that. And so you want to be talking with her and keep in touch with her about what it is you're looking for. And then on my end, when you're talking with the lender, we're going to find out how much you can afford. You need to know before you start shopping, you need to know how much you can spend on a home. So I'm going to look at your finances. How long have you been on the job? I'm going to look at your pay stubs, your bank statements, etc., to see how much you can qualify for. So you just submit the loan application to the lender, to me. I get that worked up and get your pre-approval worked up. And then that goes over to Ashley, and she'll show you the homes that you qualify for. Now, she'll know what's available. She'll tell you after you tell her where, like I said, where you want to live, what style of home, what area of town you want to be in, and how soon can you start looking. Well, you're going to need that pre-approval letter before you start looking. But let's dive into a little bit about the home buying 101. Okay, what is the process? What are the basics? How do I get started? All right, so these are the factors of the pre-approval. Everyone, this is one of the first questions we get. It's like, how do I get pre-approved? I don't know if I can get pre-approved. Here's the factors. Here's what we're looking for. Lenders are looking at your credit history. Are you employed? How long have you been employed? Are you self-employed? Do you own a business? Looking at those type of things. And then we're going to look at your qualifying income. Qualifying income meaning your income after expenses, right? So if you own a business and you write half that off, your qualifying income is a lot less than you actually earn. And we can talk about that at a different time if you are in fact self-employed. And then we look at your existing debts. And then we look to see how much you have for a down payment. And we do that by looking at your bank statement. And we see that through your credit report. We'll see your existing debts. And then we can make recommendations too to see if there's something that we can do to pay some of those items down to get you in a better position to purchase. So the importance of your credit history. What factors determine your credit score? There's a lot of confusion out there over that, and there are many different credit score models. So if you're looking at purchasing a car, for example, if you're looking at getting a credit card, those are two different types. And then there's a third type, and that credit type is for mortgages. So a lot of us look at our credit scores we get from our credit cards. Some of us are on Credit Karma and some other sites for consumers. Those credit scores, that is a great place to keep up with your credit score, to know your track history, to see what your limits are, et cetera. However, those mortgage scores are usually different. I mean, those scores are different than what we're going to get on the mortgage score. So what they look at first, if you see in the green right there, 20% is new credit and types of credit that you have. So if you get new credit and types of credit, that counts about 20%. Length of your credit history counts about 15%. Your amounts that you owe on the different lines of credit you have is 30%. And then about 35% down there is payment history. That is, as you see, that's right there. That's the heaviest weighted factor, your payment history. Late payments are the worst way to damage your score. I mean, that's the number one way you could do it. Do not make late payments. If you have late payments, those take more time. You can't cure late payments. If you have debt ratio issues, if you've got a credit card and you have it charged up to 90%, you can pay that down, right? And that helps your credit score go up. Late payments are going to stay on your credit history for a period of time. I've heard 7 years. There are some things changing in the credit. It always changes, but just the biggest thing to know is don't make late payments. Do everything you can to pay those on time. Put them on auto pay, set it and forget it, right? Now, we're going to continue talking about the importance of your credit history. So just like I mentioned, make them on time. So the reason it's so important, and if you think about it, if you have a history of making them on time, that lender can look at that history and go, well, they've made their payments on time. They are a good risk for us. So they don't make late payments. We're willing to loan them money. And that credit score, as you see in the green here, can be a factor in the type of loan, you qualify for. There's conventional, there's FHA, there's different types we'll talk about, and some are more desirable than others. So your credit score plays a role in this. It's going to also play a role in what your rate is, your interest rate, and how much you pay for that loan. So it can determine how much you need for down payment. It can determine the total amount you can borrow. So there are many, many factors involved. Um, and you got to stay on top of that. Now, I know this says obtain a copy of your credit report from your lender. We're actually not allowed to give it to you because it's a pass-through fee. We don't own it. You own it. You pay for it through us. That credit, the company that runs it, they send it to you, and I'll give you access to their phone number and email so you can get it directly. But you typically will get it within 30 days once you apply for a loan. All right. So this is a big, big, big question. And a lot of people, you don't know this. How much you need for a down payment? Well, the great news is, the best news I can give you is you don't need 20%, right? I mean, everybody thinks they need 20%. And it's just because the reason is because if you put 20% down, it's going to get you better pricing, get you a better rate. But the main thing is it keeps you from paying private mortgage insurance. So that mortgage insurance you pay just like you would homeowners insurance, or you get insurance on your car. You're going to pay insurance on that because it protects the lender if you default on that loan. So once you put 20% down, they feel pretty comfortable that you're going to pay that loan off. But if you put less and less down, that mortgage insurance will go up. We'll talk a little bit about that later. So yeah, there's a lot of different options, everything from 3.5%, 5%, and some may even qualify for down payment assistance. Now, you see that right here in the middle. There's some great programs out there that can get you anywhere from 3, 4, or 5% down payment assistance. Honestly, as a lender, I've had buyers come to me. We got them qualified for down payment assistance. They paid maybe the $2,500 earnest money deposit, which you're going to pay when you go under contract on a home. You're going to make a deposit with that seller, okay? And then we go through the whole loan process. We get your down payment assistance. If you got 5 payment assistance, that pretty much is going to cover all of your down payment, the loan cost. Sometimes, and I've seen it, sometimes it covers what you put in earnest money. I've seen borrowers get some of that earnest money back. In fact, all of it. You can't get money back on a home loan when you purchase. You can only on a refi. But in Texas, at least, you're allowed to get up to the amount of your earnest money deposit back. So I've seen borrowers use that down payment assistance and actually get into a home with zero out of pocket. So another important factor, though, is you have to be prepared outside of just that down payment. Let's say you're going to pay 3% down. There's also closing costs. Okay. You're going to have fees to pay. So you've got to make sure that you account for that. So if let's say the home, just to make this easy, it's $100,000 home, right? 3% down, that's 3,000. Well, you can't just think, well, I've got 3,000, I'm ready to buy a home. No, because you got closing costs, and they can be around 3%, some anywhere from 2 to 4 or 5%. So you need to account for that as well. And you will get a spreadsheet, a breakdown of what all those fees are going to. Um, and you've also got, and you see a list here, your appraisal, attorney fees, home inspection, and you're going to pay for that appraisal up front. And you're going to pay something that's called escrow. And escrow is your taxes and insurance. Okay, that'll be made along with your mortgage payment, and we'll talk about that further. But you just need to keep in mind, it's not just the down payment. You've got to factor in the closing costs. Okay, so you want to be clear with us, be clear with your realtor, be clear with me of how much you want to put down, and then let us take a look at that with you so we can review all of your closing costs and your down payment. You'll get that full loan estimate, that spreadsheet that shows you line by line where everything's going, and we'll make sure you have the funds for that so there's no surprises for you. So how much can you afford? How much can you afford? Great question, right? You don't want to go out and start looking for a home and find this home and go, oh my God, we got to make an offer on the home. I love the house. Before you start doing that and before you fall in love with a home, please get with Ashley and myself and let's talk about it. We want to take a look at everything we've discussed, your credit history. When I take your credit, when I pull your credit, it's going to show me everything you have right now, every debt you have, the payments you're making on your credit card. Do you have student loan debt? Are you making child support payments? Are you receiving child support payments? All of those things matter, and all of those things combined together account for what's called your debt to income ratio. So let's say right now I look at all of your debt and I see that, and then I look at your income. I can tell you what your ratio is just by doing the math, but now we're going to introduce something new. We're going to introduce a new home payment, right? So we're going to look at, let's say you find a home for 400,000, and here's how much the taxes and the insurance are, and if there's going to be any mortgage insurance, we add that in. We have to add that to all your other debts, all right? And then get your gross monthly income and use that factor, divide it to come to what your debt to income ratio is. Ideally, a conventional loan, we want to see that around 45%. However, some loan programs will go as high as 55% and sometimes a bit higher. But this is why it's so important to talk with me and talk with Ashley so we can look at your finances, look at everything, make sure you've got your down payment, and make sure your debt ratio works before you try to go purchase a home and spend a lot of time wasting your time on something that is not something that you can afford. So, if you see this third point over here, different loan programs are different. So what I do is I look at your overall debt to income ratio, and then I see which one I can plug that into. Okay, you qualify for FHA, for example, which we'll talk about. Let's see if we can get you into this other program. Let's make sure your credit score works for this program, but we're going to look at all of that so you don't have to, and we'll explain it to you and make sure you understand it as we move along. And I know you're going to have questions, so I hope you're writing those questions down, and you can always reach out to us and let us know if we missed something. Now, what's in your mortgage payment? So of course you're going to have, if you're making a rent payment right now, that's it, right? You're just paying rent, and you probably have an insurance. You might, hopefully you have renter's insurance you're paying separately. In this case, in a mortgage payment, you're going to have what's called PITI. As you see there, it stands for principal, interest, taxes, and insurance. So the principal, that's the loan amount. You're paying the principal down every time you make a payment. The interest portion, let's say the interest rate is 5%, for example. You're paying 5% interest on that principal balance each month, and that's going to the lender. That's for the pleasure of using their money to buy the home. And then you have property taxes. That's based on your county. It's based on the value of the home. You're going to have property taxes, also going to have probably your school tax, maybe your city tax, along with the county taxes. So all that plays a role. We will work an estimate for you. The home, if you're looking at an existing home, we can look at this year's tax record, for example, and it tells us exactly how much you're going to pay monthly. So we add that in, we add the interest in, and then we add in the insurance. The last one is your homeowner's insurance, hazard insurance for fire, for any sort of damage you may have to your home. And we calculate that as well. You get your own agent. If you have an agent with your auto insurance right now, usually we'd reach out to them and have them give you a homeowner's quote. Once we get the quote in, now we're going to know your principal, your interest, the taxes, and insurance. Okay, those are the four major items. And you might have private mortgage insurance. If you don't put 20% down, as we mentioned earlier, we will include that payment. And there's sometimes you're also going to have a HOA, homeowners association. So if there's a homeowners association, that's not paid in your mortgage payment. All right. You pay that to them usually quarterly, maybe annually. And every neighborhood doesn't have it, but we'll find out when you go to buy that home, we will find out if there's a homeowners association, how much those dues are. We factor that in. Okay, it does get factored into your debt to income ratio, even though it's not included in your monthly payment and your mortgage. It's counted because it is a debt that you have to account for. All right, moving on. So let's talk about the different loan types and how do we know which one's right for you. Remember, I mentioned, talked about credit score, talked about your income. We're going to look at all of those things to find out which one is going to work best for you. So we have first type is conventional loans. You've probably heard of conventional loans, and basically, in a nutshell, conventional loan is not insured by the government. So in a conventional loan, you see here, those are loans that are backed by Fannie. You'll hear people say Fannie Mae and Freddie Mac. So we have to make sure when we're working your loan that it fits inside the Freddie Mae or Fannie Mac guidelines. Okay. Then that means the credit score is a certain level, your income is a certain level, your debt to income ratio is at a certain level. It has to meet all of those thresholds under Fannie Mae or Freddie Mac guidelines, okay, in order to meet their approval. Now, these typically are for those folks with, really better credit scores, 680 and above. If you're below 680, there's still programs for you. FHA has great programs for you, and that's why FHA is there. And let's move on to that. So conventional is where we go if you've got a score of 680 or better, you've got good credit, good income, etc. So the conforming loan limits here, what that means, conforming loan, that means it meets a county loan limit. Okay, so certain areas are high priced areas like California and New York, but generally the conforming loan limit is 647,200. So if you're at that price or below, you're going to qualify for a conventional conforming loan. And you see the high cost areas, as I mentioned, California, New York goes up to 970,000. And anything then non-conforming is considered jumbo, and that would be jumbo loans are over 647. We're talking about first-time home buyers here, unless you just won the lottery. Maybe you are one of those folks that want a jumbo loan. I'm happy to talk to you about those, but primarily we're talking about conforming loans for the purpose of this webinar. They're going to be fixed rates. Now, adjustable rates are coming back on the market. They've never gone away. They didn't work because rates got so low, no one needed an adjustable rate. Adjustable rate is good for a lot of first-time home buyers, especially in a market where rates are rising. And the reason that is because you can come into this loan, you can qualify at a lower rate, okay, and it won't adjust until like 2, 3, 5, or 7 years. I would say 5 years. Most of the ones we're doing are 5, 7, or 10 years. So here's the great thing about that. If you're buying a starter home, first-time home buyer, you're most likely going to be looking to move in 5 or 7 years, okay? And that's a starter home. So then a new starter person buys it. You take your equity, what you earned and the increased value from that home, and move on to your next home, right? So a fixed rate can come in 2 points below an adjustable rate can come in 2 points below what a fixed rate is. That lowers your ratio. It lowers your monthly payment, maybe by several $100s a month, and it won't change for 5 or 7 years. And by that time, you may be looking to move. It's not like a balloon payment. Balloon payments, I will say those are bad. You don't want a 5-year balloon payment. You know what a balloon means? That means it keeps going up and up, and in 5 years, it's all due. And that bursts, right? Who's going to have it? You're not going to, don't ever do that. Adjustable rates, though, are excellent, and I highly recommend those. And if we need to do that for you, we'll talk more about it. So moving along, hey, tell me, where am I at? Check my clock.
You're doing good. We got about 5 minutes.
Okay.
So yeah, you're right on time from my understanding.
Oh, well, we're trying. I'm trying. Yeah, I got to check in with Ashley and make sure I'm doing. All right, now let's talk about the unconventional. These are your loans that are not insured by, they are insured by the government. Sorry, we already talked about conventional. These are insured by the government, FHA, Federal Housing Administration, USDA, that's And then also the state bond programs. We talked about those. Those carry the down payment assistance. Also the VA loan, the Veterans Administration, it's a great program for veterans, for spouse, a surviving spouse. You can be already a veteran currently, or you can be, formerly in the military. Those are excellent programs. If you've ever been in the military, you want to look into that before any other loan program out there. So these are the ones that are not insured, that are insured by the government, unlike conventional loans. So now we say which one is right for you. Well, that's why we get with you. I look at everything. Ashley talks to you about, oh, you do this for a job and this, oh, you should talk to Bruce, or we're going to talk to you about what you do, what your income looks like, how long you've been on the job. And knowing all those things, all those items you tell me, lets me know which program is right for you. And I'll discuss them all with you. And I'll say, I recommend this program for you, and here's why. However, here's two other options for you. Which one is right for your family? That's your decision. So you have to decide, do you want that fixed rate? Do you want the adjustable rate mortgage? Do you want the FHA program? So, and there are pluses and minuses to each of them, depending on your situation. So remember this, everyone wants to talk about interest rate. We've been in a rising environment. If you're watching the news, that's no surprise to anyone, but that's only one part of the equation. Okay, there's loan cost, there's the reputation of who you're working with. Can you close that loan on time? There's so many factors involved in this that it's just really critical that you work with a professional that knows the area and someone who's been in the business, who can offer you all types of loan programs and answer those questions to get you in the right program and get you closed on time. Okay. And we want to educate you. We want you to understand there's nothing worse than going through this process and going, I don't know what's going on. We want you to be an educated home buyer so that next time you do this, you're going to you'll already know what you want before you get out there and look at it. So let's move. I want to try to get through this in about 5 more minutes. So here's what you're going to do. These are basically the 6 steps. Complete the loan application. We've got a mobile app that is attached to Ashley. You'll get on it. We are all involved in it together. You're going to fill out the app. You're going to provide me with your income and asset documentation. That's your pay stubs and your bank statements. And then once I review all of that and everything looks great, I'm going to issue you a pre-approval letter. I send it to you and to Ashley. All right. And then step 2, we're going to review that pre-approval. You're going to go over it with her. We can all talk together. And then she's going to formulate a plan. She's going to put together a plan to see the homes that fit your budget and your needs. She'll tell you more about that. She's going to put together a list for you. You'll see pictures and lots of wonderful things. So you don't waste time, right? You can already see it before you go. And then you both are not wasting your time. You see the homes that you want to see. And then step 3, you get in that car and you go out looking and you stay focused. You stay with it. You keep in contact with us with any questions you have. If you have questions about the school district or whatever it may be, are there parks nearby, etc., that's what Ashley's going to be able to tell you. Step 4. What happened? Did I skip ahead? I know I'm trying to end early. So step 4, again, work with her. Review the offer. So she's going to get with you to say, oh, you love that home. You're ready to make an offer. She's going to advise you on how you make that offer. Here's how much you should offer. Here's what we're going to do. These are the steps we take. She sends that pre-approval letter along with your offer. You're going to submit an earnest money deposit, okay, which is typically around 1% of the purchase price. And then step 5, you're going to order an appraisal and a property inspection. Now, that's one thing you pay out of pocket up front in the loan that you will put on your credit card, however you want to do that, pay for the appraisal and property inspection. And then at that point, I'm going to collect all the updated information. Now, keep in mind, it may have been 3 months ago when you first sat down with me and Ashley and decided you want to buy a home. So now 3 months later, guess what? All your pay stubs, your bank statements, everything has changed, right? So I need it updated. So then I'm going to say, hey, send me your most recent 30 days bank statement, pay stubs, and then I'm going to review all that. Everything still looks good. It goes into processing. Our processor reviews it, goes into underwriting, and we can close your loan in 15 to 21 days. And then guess what? Final loan. It's approved, right? Bang. We're all excited. We're all celebrating, doing the happy dance, popping our champagne. And then I'm going to send you your closing statement. You'll hear CD. Oh, your CD's coming out. You get that signed. It's so important. Look it over. We can still make any changes if we have to make some minor changes here and there, but get that CD signed. Ashley would tell you we have to meet our closing time, and we can't meet the closing time if you don't sign the CD. Sign the CD and we can close as soon as 3 days later. The law requires a 3-day waiting period in there. So that ensures that you've had time to review it. So then title company, Ashley and myself are going to get with you and tell you, here's your closing date and time. They're going to schedule at a time that's convenient for you. You're going to go to the closing and sign the documents and get the keys to your new home. So pretty simple, right? I don't need to recap unless hey, somebody's coming on late. Look, here's what we talked about. So you can rewind. Owning versus renting. Why owning is better? We talked about the pre-approval process, how to get that pre-approval letter. Talked about your credit report and the importance of your scores and making payments on time. Talked about your down payment options, everything from 0 down to 3% to 5% to 20%. We talked about the closing cost, the CD. We talked about your loan programs, mortgage payment details, what's included, principal, interest, taxes, insurance, and the 6 steps in the loan process. Now, we know you have questions. And if you have any questions, we're happy to answer them now. If you'd like to scan the barcode here, you can scan this barcode if you're driving. You might want to wait and do that. Pop in here, Ashley. See if you what do you got?
Well, I did have a question that came through. This was a great conversation that I had at some point during the week. And, I'm talking to a first time home buyer, and he's aware that, we all are aware that the interest rates are rising. And he said, Ashley, did I miss my opportunity to buy? Like, did I miss the market? And I said, oh, absolutely not. The rates are just going back to normal. We're actually normal when it gets to the rates that we're at right now and what we're projected to have happen. That's kind of our normal market. We just
Yeah,
happen to be a little lower than we have been in a very, very long time over the last 24 months. So
right.
no, you didn't miss the market at all. We're just getting back to normal.
Right. And listen, you heard everyone say, hey, we're at historically low rates, right? Historically low rates. And we were hearing that for 2 years. So, I mean, when you hear about a 100-year flood, we may not see historically low rates for 100 years. But I'll tell you this, and if you're an old guy like me, you can remember when interest rates were 15 and 18. The first home I bought, the interest rate was, I think it was 16%. That sounds insane right now, doesn't it? But we're not going to go there. I don't think we'll ever see those rates again. I think we're probably going to stay kind of where we are. We're around probably between 5 and 6 right now, depending on loan program and your credit scores, et cetera. But no, that's a great question. I can show you another webinar and show you the cost of waiting. And it's very important to understand that. If you think I'm going to wait until rates come back down, all right, guess what? While you're waiting, home prices are going up. Okay, they're going to keep going up, right? So you're paying more right there. And what if rates go up another point? I can give you an example. Let's say 4 months ago, if rates were 2 points lower, and you're buying a $300,000 to $400,000 home, the payment increased $300, $400, $500 a month. So I wouldn't wait. I would, if you can do it, take 3% or get one of the 0% down loans. The interest rate should be, it's only one factor. But if you can make the investment in yourself into home ownership, do it. You're just spending money on rent when you could be putting that into yourself, investing it into your home and into your family. So let me ask you this. When you go to sleep at night and you're thinking, I've got this $1,800 a month rent that I'm paying, you're not thinking about interest rate. So if you go to sleep at night and you're making an $1,800 a month home payment and you know it's going into an investment for yourself, you're not going to be thinking, oh my gosh, I have 6% interest. I promise you. In fact, most people, when I talk to them, Ashley, and you might be able to know this too, if they're going to refinance, I say, hey, what rate do you have right now? Oh, I don't know. I need to go look at my mortgage statement. And that's the truth of it. You want to know what your payment is. We want to get you the best rate. We want to get you the lowest, most affordable payment possible. And we want to help you get into your home so you can begin investing in yourself. Right?
Absolutely. So, just to respect everybody's time, I do not see any questions in the queue. And unfortunately, Bruce, is there a way to kick me off the screen and put our
Yep.
information back
Sure.
on? We understand you're coming from work. We understand you're driving. Please, please, please don't panic. I do this all the time in the car. I see my favorite song come on Sirius XM. I take a picture so I can remember, just snap a picture of this. It'll be in your pictures. We know that you're going to go home and you've got tons of things to do. We appreciate you hopping on board. We hope you found value, and we would love the opportunity to invite your friends and your coworkers, your family members to come visit with us. We are more than happy to provide service for you and to help others get and achieve the dream that they want to have for their friends and their families. So, this is the best way to holler at us quicker, I guess, from tonight's call. And we just want the opportunity to, start here with both of us. 30
Absolutely.
minutes is all it takes. And you'll walk away from that call like with all kinds of golden nuggets and ahas and maybe even a game plan. I mean, Bruce, wouldn't you agree? We're in the game plan business, right?
That's it. We just want to get you started. Listen, you might not buy a home for 6 months to a
Mhm.
year, but we're going to at least put it on paper and give you a goal and steps to getting there. Okay. Right now, you don't know. You're curious, and we want to answer the questions. We might say, you know what, your credit isn't quite y- there yet. Maybe it can be there in 3 months, maybe in 6 months. We will work on a plan with you so that we can help you stay on track and get to the desired end result, which is purchasing your first home.
Abs-
So we're
Absolutely.
back here on the 14th,
Mhm.
on June 14th, 6 p.m. on all of these social media platforms. We hope you tell your friends, family, if someone you know is looking to make their first home purchase and get out of that rent trap and stop making their landlord wealthy, please reach out to us, and we're just here to help. We love to help, and we love what we do. So we look forward to talking with you.
Yay. Thank
All
you so
right.
much for your time. Y'all have a fantastic rest of your short week, and we'll see you in 2 weeks. Bye.
Absolutely. Thanks, Ashley. Bye bye,
Thank
everyone.
you.